Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Mish Schneider, Director of Trading Education over at MarketGauge. Mish, it's great to see you as always. Welcome back to Trade Talks.
Thank you for having me, Jill.
All right, 2022, quite the start for traders with all the volatility that we're seeing in the market. And of course, today is no exception. There's four factors in the market that you think are really contributing to the type of action that we're seeing today. And of course, since the beginning of the year, inflation, of course, is one of the culprits.
Well, yes. And even though there are some statistics that came out today that inflation may have peaked, I think that that's kind of myopic because everything ebbs and flows, as we know, but really nothing about the idea of inflation has peaked. And particularly the fact that we still have a lot of lockdown globally, and that demand still has pent up and will come back, and even in this country as well. So I still believe that we have a shortage of raw materials with a demand that can exceed the supply, and the supply chain still impacted, and of course, the labor force as well. So that's why inflation is still very much on our lips.
Right. And of course, we are in the thick of earnings season, and we have, the Nasdaq 100 heavyweights coming out next week and the week after. What are your thoughts around earnings? What are you watching there?
Well, again, I really did not expect to see incredibly robust earnings across the board. Of course, there's always going to be exceptions, but let's take Netflix, for example. People were seemingly shocked at the fact that the stock dropped 23% after the bad earnings report. And actually, the earnings report wasn't great. And that's really wasn't as bad, as what the numbers suggested in terms of the reaction. And that's always what happens with earnings, is not so much because that's kind of looking back. It's really the projection looking forward. And Netflix was raising their subscription fees. So getting back to earnings in general, the banks were very divided. The banks that were able to really cut their expenses did better than those that couldn't. And I think that's kind of going to be the theme here, is not so much what happened before, or what the forward guidance is going to be, given our new economic environment that we have, which is really, I think, going into a stagflation.
Right. And I would agree with you there, particularly when you think about retail earnings, which of course will be taking place over the next few weeks as well, because while holiday might have been okay, we still had a lot of lockdown, staff shortages. We had less hours with stores open for those reasons alone. So I think the guidance is really going to be key there. And of course, when we think of retail, we think about the consumer, and consumer spend is just so critical for our Fed policy. It's critical for our economy. It's critical for what's happening in the stock market. So speaking of the Fed, interest rates, of course, are going to be one of the top four that you're watching.
Absolutely. And I feel that everything we've talked about with the Fed is also so much the case. They came out with the hawkish talk, but they came out at the hawkish talk when the market was near the highs. Now that we're seeing some of these numbers coming in, like jobless claims going up, and with the labor shortage still very much a factor, and with the contraction of the manufacturing sector and consumer sales and retail sales being weaker, I think the Fed really has to focus more on that. And they're well aware of the pickle they're in because of the fact that inflation is here. And even Janet Yellen admitted today, oh, well, I guess we didn't realize just how high inflation was going to go. Makes you wonder about these people that are in charge, which really means a bigger picture we can get back to. But I just want to talk about the credibility of so many things have been in question. But in terms of interest rates, yes, I think the Fed will continue with the reduction of the bond buying, although they haven't to date. And if they raise, we even have to figure the fact that even if they raise twice, three times, we're going from 0 to a 0.75% interest rate. If you look back at 1980, the last time we were in these sort of inflationary numbers, the interest rates were 6, 7, up to 12, and then finally to 22%. We're nowhere near those levels right now. So I don't think I would be so concerned. I would be concerned about the fact that the Fed has now put themselves back into a corner, but I wouldn't be so concerned about these much higher interest rates that people are talking about.
Right. And it seems like it's a big, giant valuation reset. And of course, the fourth thing that you're looking at is money flows, and really the rotation trade and where you're seeing money come in and out of has been a big part of the story.
Absolutely. And that's why really my conclusion, and it's not a very popular one, but I'm going to stick to it for now unless proven wrong, is that we're really more into this range bound type market here. And even though you can break the floor of the ranges and the classic support that goes back to the beginning of 2021, you could still come back through it. And that's where the retail investor comes in. The retail investor has really bolstered this market, has become the predominant player in the market over the last couple of years. And now the retail, I think, market is smarter than what people give them credit for. And I believe that they will figure out very quickly that this is not necessarily going to be the hyperbolic bear market or the hyperbolic bull market, but rather a range-bound stagnant market, which goes economically with a stagflation scenario. So that means I think we see these dips. And I'm not saying buy the dip, but we see these dips that get supported over a couple of days, stocks that outperform. And I think you'll see that money flow continue, and that'll be a positive.
Well, of course, the challenge is for the past 10 years, Mish, it's just been one, everyone buying the dip, going from the bottom of the left to the top right of the chart. So it could present a challenge as sort of the composure of the market and the composure of how things trade. It's been almost a decade since we've seen a relatively normal range bound kind of market. And to wrap up here, when you look at VXX, when you look at VIX, when you look at the volatility complex, are there any clues that you can see there?
Well, volatility obviously has picked up this week, and that's to be expected with the market moving down. But if you look at volatility historically, it's still really, really low. And I think that, again, supports the stagnation and the stagflating type of environment that we have in a range-bound market. So you do have to keep your eyes on volatility. If it starts to pick up, people like to use the adage over 20, it's bearish, under 20, it's bullish for the market, that is. Right now, I think that volatility has picked up, but it's just hitting resistance, and that will help us really determine just how correct this trading range kind of idea for trading is going to be this year. And again, that will help, I think, the retail investors adapt and get more creative in terms of how they trade, other than what you just said, which is basically buy every dip and expect everything to explode to the upside.
All right, Mish, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.